Holy smokes, take a look at the data coming out of the Toronto Real Estate Board for real estate sales. The volume is dried up by over 50% and is continuing to drop off in November, represented by this bar line that's yellow for 2022. We've got 2021 in blue, 2020 in green, and then 2019 in gray. Nothing comparable to the past performance thanks to this interest raising environment. The Bank of Canada announced last week they're raising another 50 basis points ahead of the US Federal Reserve meeting, which is likely to follow suit with a 50 basis point hike. But take a look at this basic sales to new listing ratios and the average price annual percent change, because oh my god, these numbers are only comparable to the March 2020 period and then again the 2008 financial crisis. I'm not saying that real estate is going to correct as bad as it did in 2008, but these data points are very reminiscent of that time period well over a decade ago. And people are getting absolutely squeezed. Let's take a look at the current mortgage data and see what kind of mortgage rates we can get in this current environment as of December of 2022, considering the average price of a home in Toronto and the Greater Toronto area is still sitting around 1.1 million, presuming you're probably going to have to put around a 20% down payment in this kind of environment. That means about $200,000. Let's keep it at a million even, which means the principal amount that you're going to owe on this property is going to be $800,000. Taking a look at the current interest rates we can get here, we can get a 3-year fixed at 5.6%, a 5-year fixed rate mortgage at 5.54, and this is coming from the Toronto Dominion Bank mortgage payment calculator. We can see a 6 months convertible is sitting at about 6.5, but what a lot of people aren't paying attention to anymore are these variable rates. Now we have 5-year closed variable rates at 6.2% and 5-year open variable rates at a whopping 7.6%. But let's say we're conservative here. We want to lock in a 5-year rate. That means on a 25 amortization period, but presuming we're all going broke here, we're probably gonna have to max this out to the 30-year period. And taking a look at the monthly payments, guys, let's hit that calculate button and realize that our payments alone just for this mortgage, again, we're not talking about property taxes, we're not talking about housing insurance, we're at $4,763 damn a month just to basically own a property in today's environment. Now, if that wasn't enough, our Canadian banks do exactly the same thing the US banks do, and I think they're trying to put a squeeze, and they're really squeezing this market heavily. And I noticed the Jerome Powell, the head of the Federal Reserve in the US, made some comments on the last meeting that are very reminiscent of what I think the Canadian banks might be trying to do to some degree. Not talking about a full-on reset, but take a listen.
Plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place.
Now, obviously in Canada, I think we're going through the exact same scenario. If anything, I think Canada is way worse off because of how extended our housing prices got, all things considered. But let's just take a look at the actual data coming from the Toronto Real Estate Board on the current market stats as of the 5th of December of 2022, because this backdate's giving us the full month of November data with total residential transactions dropping by 49.4%. That's again year over year data, but on a seasonally adjusted basis, that's 2.4% month over month. The average selling price, guys, is coming in just down 7.2% over last year, with the seasonally adjusted rate actually increasing for the month by 0.3% over October, which means we're starting to see some nominalization. But I think that is mostly coming in with like condo sales, probably give or take, because I talked to real estate agents around Richmond Hill, the surrounding GTA area, and they said premium luxury homes aren't selling. Anything between 2 million and below, which is better to average pricing, are still moving, but slower than obviously they were last year, with the total new listings falling off a cliff. I mean, they're down 11.6% over last year. And the percentage of sales to new listing ratio, which was the data we looked at the beginning of this video, is down 38%. So definitely volume drying up here, with property days on the market up 83.3% year over year. Let's take a look at the condominium sales, because this is more intriguing, because I think more to the average person is buying condos, which are definitely more affordable, or reasonably more affordable, with total condo apartment sales down 46.4% year over year, which is crazy. But the average selling price is actually up year over year by 4.5%, because again, I think the more affordable housing is what most people are focused on in a market like this, with total new listings down 16% year over year, sales to new listing ratio down 23% year over year, and days on the market have increased by 31.6% year over year. Definitely giving some note to Jerome Powell there, saying, when we were competing sight unseen sold homes, is those days are over, I think. I mean, we're definitely seeing homes stay along this market for a long time. With condominium rental stats, the total apartment rentals, guys, are actually down year over year, so we're not seeing nearly as many condo apartments. That's obviously driving up some of the condo rates we've seen this year for people looking to rent, with the average one bed rent up 20.4% year over year, which is kind of staggering. And I think we're even higher than this now at 2481. And then the total new listings, guys, minus 25.6%. So again, I think the condo market is probably showing the most resiliency here. And it's kind of scary to think that, the Canadian households experienced a decline of almost $1 trillion in net worth in the second quarter amid plunging prices for homes and stocks. It's kind of, insane to think that most of Canada's entire wealth is in the real estate market. Canadians' net worth, I think over 55% of Canadians' net worth reside within the Canadian real estate market. Now, if you're a millennial like I am, maybe you're asking yourself, what options do I have if I want to get into the real estate market, if I want to be able to afford real estate? Well, first and foremost, if you're living in one of these super high premium real estate areas, being Toronto or say Vancouver, you better have some very wealthy parents, or you better be making well over $250,000 a year as a household if you're even going to come close to affording the average price of a home over $1 million here. But you could do what we're planning on doing, which is perhaps geo arbitraging, looking at places like Alberta, where the actual wages are higher than they are in Ontario, surprisingly enough, probably thanks to the oil sector, but where you can also get housing for about less than half as much, and the rental prices are around $1,200 to $1,500 a month, in comparison to Toronto here, where you're looking at around $3,000 a month, and again, comparable to Vancouver. But there are some other options the government's trying to finally help us out with, which this doesn't really help out much. But if you're like me, you want to squeeze every dollar you can out of your savings accounts, we are going to see in 2023 the tax-free first home savings account. Now, this account particularly is going to allow you to put up to $40,000 towards your first home. To qualify, you have to be a first-time home buyer, so better probably for most millennials or younger. They're going to allow you to deposit up to $8,000 a year, and there are some loopholes, some really fun ways to take advantage of this that I'm going to be talking about in a video coming up. If that's something that you think you'd be interested by, consider subscribing. But I'll pass the question off to you at this point, guys. Though I see bearishness in the real estate market as it stands in this very moment, coming into 2023, 2024, inevitably when all of this levels out, we still have a major supply and demand problem. The demand just shifted to the rental market, and inevitably it will come back. And I really think that if you have liquidity in this market, there are people that will not be able to afford these variable rate mortgages, and this is your opportunity, if you wanted to buy a house, if you're in a position to start negotiating and looking for those people that are desperate to get out of these mortgages. But I'll pass that question off to you.